Question 11. Bruno's lunch counter is expanding and expects operating cash flows of $26,000 a year for 4 years as a result. This expansion requires an investment of $39,000 in fixed assets at the beginning. This investment does require depreciation but is worthless in the end with zero cash flow implication. In addition, the project requires $3,000 in net working capital, 100% of which will be recovered at the end of the project. What is the net present value of this expansion project as a required rate of return of 16%? To start off, years 1 through 4 are 26,000. The NWC is $3,000 investment at the beginning, but we get 100% return at the end. The investment opportunities are negative 39,000. And the total CF is the sum of everything above. The rate is 16%, which makes the NPV value, plug in the rate, plug in year 1 through 4, and add your 0 at the end to get a value of $32,409.57. Question 12. Jasper Metals is considering installing a new molding machine which is expected to produce operating cash flows of $73,000 a year for 7 years. At the beginning of the project, $10,000 in additional net working capital will be needed. All net working capital will be recovered at the end of the project. The initial cost of the molding machine is $249,000. The equipment will be depreciated straight line to a zero book value over the life of the project. The equipment will be salvaged at the end of the project, creating a $48,000 after-tax cash flow. What is the net present value of this project given a required rate of 14.5%? To start off, year 1 through 7 is 73,000. The NWC at the beginning is negative 10,000, but we get 100% at the end. Investment activities are negative 249,000, but after year 7, we get 48,000. Total CF is the sum of all above. Drag that over. The rate is 14.5%. Rate, year 1 through 7. And add your 0 at the end. Get us a value of $71,801.34. Question 13. Kelly's Corner Bakery purchased a lot of Oil City 6 years ago at a cost of $280,000. Today, that lot has a market value of $340,000. At the time of the purchase, the company spent $15,000 to level the lot and another $20,000 to install storm drains. The company now wants to build a new facility on that site. The building cost is estimated at $1.47 million. What amount should be used as initial cost flow for this project? To start off, we need all the relevant costs, which a lot of them are sunk costs, so they don't matter. So it's $34,000 as the market value, and then $1.4 million and we take the sum of those to get an answer of $1,810,000. Question 14. Precise Machinery is analyzing a proposed project. The company expects to sell 2,100 units. The expected variable cost per unit is $260, and the expected fixed costs are $589,000. The depreciation expense is $129,000. The sales price is estimated at $755 per unit. The tax rate is 35%. Part A, what is the operating cash flow for the project? Part B, what is the accounting break-even quantity? Part C, what is the cash break-even quantity? Part D, what is a financial break-even point? Assume that the operating cash flow calculated in Part A is the OCF, where NPV is 0. To start off, to find sales, we do the 2,100 units times the price, or times the sales price of $755. Get you $1,585,500. The variable costs are the 2,100 units times 260, which is the unit cost. The fixed cost is given at $589,000. The depreciation is given $129,000. To find the tax income, we do the sales minus variable costs minus fixed costs minus depreciation. The tax is the taxable income times 35% tax rate. And the net income is the taxable income minus the tax. Bring down net income and depreciation. And the OCF is the sum of both of them, to get a value of $337,975. For Part B, you plug in the fixed cost of $589,000, and that's the same for all of them. The depreciation, $129,000. The price is $755. And the variable cost is $260. And for D, the OCF is the what we got in the problem above. So for B, we make sure to do parentheses fixed cost plus depreciation divided by the price minus variable cost. That gets us a value of 1,450.5. For C, you take the fixed cost divided by price minus variable cost. That gets us a value of 1,189.89. And for D, we take the fixed cost plus the OCF, which is divided by the price minus variable cost. That gets us a value of 1,872.67. Question 15. At the accounting break-even point, Swiss Mountain Gear sells 14,600 ski masks at a price of $10 each. At this level of production, the depreciation is $58,000 and the variable cost per unit is $4. What is the amount of the fixed costs at this production level? So we have the formula, and the Q, we have 14,600. which is equal to the FC, which is unknown, and the depreciation of 58,000, which is divided by the price of 10 minus $4. We just solve this now. For $14,600 equals, or we multiply each side by 6, so times 6 equals FC plus 58,000. Subtract each side by 58,000. And solve for fixed costs. Gets us a value of 15,000. Sorry, this is a 6. Actually gets us a value of 29,600. Question 16. The Coffee Express has computed its fixed cost to be 34 cents for every cup of coffee it sells, given annual sales of 212,000 cups. Depreciation is $56,920, and operating cash flow, or NPV equals 0, is $94,244. The sales price is $1.49 per cup, while the variable cost is 63 cents. The company's tax rate is 30%. How many cups of coffee must it sell to break even on an accounting basis? How many cups of coffee must it sell to break even on a financial basis? So we have our formulas here. Q is 150,000. The depreciation is 56,920. The P is 1.49, and the variable cost is 63 cents. To solve for fixed costs, we do 34 cents times the annual sales of cups, which is 212,000. Solve for Q. Do fixed costs plus depreciation divided by price minus fixed variable cost. Gives us a value of 150,000. Part B. To find fixed costs, we do 34 cents times 212,000 cups. The OCF value is 94,244, and the price and variable cost are the same. To solve for Q, do fixed costs plus OCF divided by price minus variable cost to get us a value of 193,400. Question 17. A project requires an initial investment of $1 million and is depreciated straight line to zero salvage over its 10-year life. The project produces items that sell for $1,000 each with variable cost of $700 per unit. Fixed costs are $350,000 per year. What is the accounting break-even quantity? So the fixed cost is $350,000. The price is $1,000 each. The variable cost is $700, And to find depreciation, we do 1 million divided by 10 years. To solve for Q, fixed cost plus depreciation divided by price minus variable cost, to get us a final value of 1,500.